Hello fellow traders, Scott Norris here with FX Renew, doing a rundown on gold and a potential short opportunity here given a few different big technical indications that we're seeing on the daily chart. So gold having just reached new all-time highs in December of 2010. Now here we are, the first trading day of 2011, and gold had a strong finish last week in 2010 was a big one. We're right now at $1,414 an ounce on the spot price. And you can see here in early November, we formed what looks like could be the first shoulder. In early December, the head. And now in early January, perhaps, the second shoulder is forming of a head and shoulders pattern, which we know to be very, very bearish and just a classic bear pattern. But there's some other things here that really sound the alarms for me. First and foremost, we've just been struggling to make new higher highs. You can see the high here in October, a new one in November, and then finally in December. Now we're failing so far to test this high. You can't call it a failure yet because we haven't seen a reversal. But, we struggled to make these higher highs, and the higher lows were also just, it looked painful. You saw the sharp sell-off here, another pretty sharp sell-off here. So it's obvious that the longs are getting a little worried up here. Okay, now, today is hardly a significant down day. Right now we're down about $6.50 an ounce. For me to want to get short in front of this long-term runaway train to the upside, I'm going to have to see a major failure day. We're going to want to see a big head fake higher followed by a closing price that is basically an upside down hammer on the candle, and that'll really help me feel like that's the day to pull the trigger. But right now it is certainly setting up. A big confirming factor for me too is two consecutive times we've seen negative divergence with prices and MACD. And what negative divergence means is when prices create a new high and the corresponding highs on the oscillator, in this case the MACD, are lower. So you can see we had 3 higher highs, and the MACD, each time the corresponding high on the MACD got lower. So that's called negative divergence, and it's a huge bearish signal. So this is something we need to be watching. But we also, again, need to be cognizant of the fact that this is a very major bull trend that we're in, and I'm going to need to see a big failure up here or some sort of a very strong selling day that says this is it. Because let me tell you, when the boat is so heavily loaded on the long side, this won't be a covert sell-off. This won't be something that just sort of happens, death by 1,000 cuts. We're going to see a capitulation, in my opinion. That's the most likely scenario, is that the longs rush for the exits and you see 20 and 30 and 40 point down days until we get a 10% correction, which might bring us down to about 1280 right now. So we're looking for a big down move, but we really need some confirmation. And today this isn't the kind of look that I want that says, yeah, this is the time, pull the trigger, get short. But certainly something lining up, and a good example of utilizing two very bearish signals together, which in this case is a chart pattern known as head and shoulders, and the negative divergence between prices and the corresponding MACD. Thanks, I hope you enjoyed the video.